Good evening, and welcome back to Hurdle Rate. For this video, we're going to do a DCF analysis for Visa. As you can see on the graph, over the last few years, it's had a very good run, going from a low, well, the low seems to be about 175, with the peak hitting nearly 375. So over a couple of years, that's a very good return. The last few months, it has seen a downturn starting. It's broken through the 50-week average and looks like it's heading towards that 200-week simple moving average. So let's build a DCF model for this on Excel from scratch, and we can see what the company is truly worth. So yeah, let's crack on. Open up your spreadsheet and then come onto the SEC website and search for Visa. We actually have the 10K here, which is their most recent report, because their year finishes at the end of September. So that is we only need to open up one financial statement, and that's the 10K. We don't need the 10Q. So as we always do, let's go onto the spreadsheet, go page layout. We remove the grid lines. We need to freeze, so then go view. We need to freeze the first column and then insert. Whoa, why? That's better. Then we make our A smaller and our B larger. And in cell A1, let me zoom in a little. Cell A1, just put V. Then go data, stocks. It's on the NYSE, the New York Stock Exchange, so let's select. Now we can start with our, building out the model. So we want ticker in this cell, date, the current price implied, and then we want to know if there's any up or downside to this stock. So let's just do a bit of formatting, as we always do. Order, we want the dotted line. All you have to do is just copy these onto this one. So ticker, we go equals A1 dot, open your parentheses, ticker. The date today is the 7th 07 12 2025. Current price equals A1 dot, open your square brackets, price. There we have it. These two we don't do anything with yet, as we do not have that will come from when we've built the model. On your 10K, come to page 45, actually 46, and these are going to be the revenue segments that we will use. Service revenue, data processing revenue, international transaction revenue, other, and client incentives. So as always, we just put in a sort of a header on white, visible. There, center the X. Assumptions. Revenue segment, bold that. Which is Bear base bull. The first segment is service. Only one data processing, international transaction, other, client incentives. Switches, we copy this down. Same here. In the switches, just leave them at 2. And we'll put the bear case at 95%. This will all make sense as we build out this model. And these we'll look at what comes out, and then we'll decide what we're going to forecast the final year growth rate to be. We need EBIT down here, WACC, TGV, which is your terminal growth value. We need these again down here. Copy these here. Leave it. Yeah, this doesn't need 95% yet. We're going to do that a bit different. There we go. Okay, we've built out our assumptions. Now we're going to go into the revenue build. This is the first part of the DCF that we'll do. So equals, I think it's B10. Percentage growth. We want the bear base bull. It is good to know what each segment is as a percentage of revenue too. So do a bit of formatting on it. We want to go for the revenue, so it looks like this. It's in millions, and that's what our model will be in as well. We're going to, so it goes 17,539, but this number is 17.5 billion. We don't want any decimal places. We use the thousand separator, and we use brackets for negative numbers. This, we're going to start 2023. Pull this along. We don't need this last one. I will zoom in a bit more. Better. Okay, so let's start filling this out. So 2023, 14,826. 14,826. 16,114. 17,539. To work out the percentage growth, we take the year that we're looking at, so in this case 2024, divide it by its previous year, and then we subtract 1. Turn this into a percentage, as so. We just pull that along to here. Then we are going to now start forecasting out for the revenue segment. We'll take the average of those last few years to forecast for next year. Then going ahead, what we will probably say that this will be is, it will probably be, Let's say it goes to 8.5%. So for this one in 2030, we put equal to G9. We also want to make these a 2 decimal places. Percentage 2 decimal places. To work out these next three, we go equals in this in the 2027 cell. We go equals the previous year subtract open brackets the previous year minus the final year close brackets divided by the final year minus the previous year, in that case 2026. And we want to use this when we copy paste it elsewhere for the next segment. So here we need to lock in certain elements of it. So for this one, we need to lock in the column, but not the row. For this one, we lock in the row and the column. You put a $ between the letter and the number. And then that allows you to lock in it means that will stay the same every time you copy paste it, and it adjusts. Then F22, we need to lock in the row, but not the column. So not the letter, we need to lock in the number. Have it. Copy that down like that. And this, I mean, we imagine, because we can go a bit. We're going to imagine that visa growth is fairly stable. It's not going to deviate too far from this going forward. So yeah, this looks quite good. Now to work out the bear case, we take the base and we multiply it by the bear scenario. Work equals multiplied by E9. So we $ in front of the E and a $ in front of the 9 to lock that in, which means we can copy it over, and it will, as you can see, it will always use that cell. We do the same for the bull, multiplied by I9 equals multiplied by $I$9. Pull that across. There we have it. So what we want to do now is we want to link this up dynamically so that we can flick through these different numbers to forecast what the revenue is going to be. The way we do that, we go equals, we use the offset function, and then we select the cell that we're in this case, F25. Then the switch we're using, in this case C9, but we have to lock that cell in, then another comma, 0, close. Pull that across. And I'll show you how it works in a second. Let's just forecast the revenue so that you can see it. You can see it in action, basically. So we go equals, take the previous year multiplied by 1 plus the growth rate, close your brackets. And there you have your forecast for the next 5 years. So as you can see, we're on a 2 at the moment on our switch. The 2, that means we're on the base case scenario. We're using this 8.77%, 8.7%, 8.63, 8.57, 8.5. Watch what happens. Remember these numbers here. Watch what happens when I change it to a bear case. So if I put a 1 in there, it comes down. Come back to base and go to 3. And there we have it changing. So that's how we'll be able to flick through and we can flick through all of these different ones to get a range of implied share price basically. Okay. Data processing. It's fine. Let's fill that in. 16007. 17714. Yes, and we're going to forecast a growth rate of, this one will be a bit higher. I mean, look, it's there. So let's say it does do 10%. And put all of these to the correct cell to make sure you're bare, and make sure this one corresponds to this one, rather than, because you copy pasted, it's going to go up to this one. And same with the ball. For the offset, you just change the C to 10. Pull that along. Have it. Looks good. Copy paste again. And we're on B11. Transaction. It's 11638, 12665, 14166. We'll estimate a growth rate of, let's go with 8.8%. B11. All of these to 11. There we go. Looks good. Oh, sorry. Oop. Equals 12. 2479. 3197. 4053. This is growing fast. What we will, let's say this goes to about 23.5. Fix all of these. You just want to make sure they correspond to the correct cell. Okay. Yeah, that looks good. Now the last one, client incentives. What this is when it's when, I guess, Visa gives favorable terms to certain merchants. They give them discounts, these types of things, and that comes in. That comes in here. So we'll go minus 12297, 13764, 15751. Oh, sorry, negative. What we'll say that this will go to is We will say that, yeah, let's keep it at about, say, let's say 12%. Because it's negative, we have to flip these around. So on the bear case, it's going to be more negative, and on the base, on the bull case, it will be less negative. So yeah, so we have to do those. Yeah. Okay, now we can sum up our revenues. Let's just draw a border. This line here. Total revenue equals sum yeah, I think that's it. Just always make sure that your total revenue is what is on the financial statements. Perfect. Yeah. Yeah. Okay. So yeah, I mean, we're saying, let's say, 10.5% annual growth for revenue. Now we've done the revenue build, we're going to move on to the income statement. The first part of the income statement we've already done because the line is revenue. You go equals and always make it equal to what we've done in the above. Then the next one is EBIT. We want to know what this is as a percentage of revenue. Copy your format. Go below EBIT is, we want to know what these are as a percentage of EBIT. Okay, so for the financial, what do you call it? The income statement, we have to come down here to page the income. Here we are, to page 60. What we want is operating income. Is 21, 23. Yep, okay. So 21,000, 23,595, 23,994. What this is as a percentage of the total revenue. Wow. It's nearly a 65% operating margin. That's huge. I mean, 2025 has been a lot lower, which isn't great. For now, this EBIT is just a placeholder. We're going to do the proper one later. So just average out the last 3 years and then copy across. To work out the future EBIT, you just take your revenue, multiply it by its margin, the percentage of revenue, copy it across. There we have it. Taxes, income tax provision. Use this line here correctly. 3764 4173 4136. We want to know what the tax rate is, the tax divided by the EBIT. So yeah, about 18%, well, towards 17. The average of the last 3 years across your EBIT, multiply it by your tax rate. There we have it. Cool. We move on to the cash flow item, and these are depreciation and amortization. You want to know what that would be as a percentage of revenue. We can also look at what it is as a percentage of capex too. The last one is change in net working capital. I'll show you how to do that when we get on. Okay. So the cash flow statement is the last of the financial statements. This one here. So we want to look at this line, depreciation and amortization. This is our change in net working capital. We sum up these figures. Then purchase of property, equipment, and technology. That is our capex. So 943 1034 1220 divided by your revenue to work out percentage of revenue. Long. The forecast, we're just going to average the last 3 years. Revenue multiply the percentage of revenue. There we have it. Good. Formatting. So capex is this one. So 1059 1257 1482 divided by the revenue. Just copy this one, formatting from that cell, and there we go. Revenue, multiply it by of revenue, we have it. So you take your depreciation and divide it by the capex. This shows how they move. So yeah, as we can see, the depreciation and amortization is getting significantly smaller. Well, from this year, from 2023, it stayed stable, I guess, subsequently, but it was quite a bit lower. When depreciation and amortization is lower than capex, it does tend to it reduces cash flows, because you'll see when we get there of how we calculate them. But let's focus on this one now, the change in net working capital. So equals sum minus 160, comma, minus 250, comma, minus 11,014, comma, minus 24, plus 34, minus 194, 1291, 295. Okay, equals sum 37, no, sum minus 75, minus 27, minus 14,067, minus 199, 109, 1841, minus 676, minus 28. Equals sum 374 minus 542, 314, 7, 847, 3. Okay. Equals divided by revenue. Go. Take your revenue, multiply it by the percentage of revenue. Have it. Now we're on to the DCF. And on this bit, we're basically just going to copy all of this down again, but you'll see how we do it, because there's certain figures that we need to calculate. So again, we just go equal revenue, growth, we need that, is equal to what we have here. It across. Know the For EBIT, copy one of these down. If it's very fit. Go. We're going to say that we want EBIT as a percentage of revenue. And we're going to say that this will go to, it is forecast to increase, I think. I mean, 2025, that's significantly lower. Let's say it settles at 63. 60. Okay. This, I mean, this operating income here is significantly lower than. Look, if you look at this, this is 21 billion, 23, going up to 23.5, and it's only marginally up this year. Despite revenue doing very well, there's a big drop off here. So we'll have to see what reasons these are in the next few, I guess, statements, and then we can take it from there. I don't think it stays back up. I think there's some litigation going on at the moment, so I think that's the reason. Yeah, litigation provision increase in fiscal 25 over the year, primarily due to higher accruals related to US covered litigation. So yeah, that will be the reason, I guess. Once that's resolved, we'd expect it to come back up. Does it come back up to these levels? We don't know, but we'll keep an eye on it, I guess. That's keep it. This should be percentage of revenue. Okay, we have the first 3 years of taxes. Copy this to here, this to here, then average take your EBIT, multiply it by the tax rate. Okay, great. Now, if we can back here, you need to put a border there, as so, and we type EBIT, which is earnings before interest but after tax. We want to, for these cells, calculate what the EBIT is. And we do that by taking our EBIT and subtracting the tax. You can bold that, pull that along. And just to let you know, when you play with these switches here, it will adjust the tax because we've done the EBIT multiplied by the tax. So this will come up and down as and when you play with this, which is good. Then we want DNA, capex, change in net working capital. The free cash flow is going to be huge because of the negative change in net working capital. But we'll just pull all of these down. This along. Okay. Copy your border again. We want to calculate unlevered free cash flow. Do this. We only do it for the years that we're projecting. So we go equals. We take our EBIT. We add back in depreciation and amortization. We then subtract our capex, and we subtract the change in net working capital. Because most of these are negative, they're going to be positive. So the free cash flow generation is huge. Ah, where's it gone? There we go. The next step is we want to calculate the present value of unlevered free cash flow. To do this, we need to calculate something called a WACC, the weighted average cost of capital. We have to go onto another sheet now. And as we've, for those of you who followed on before, you'll know this quite well. So yeah, just make your A smaller, your B bigger. Again, you'll put the V in the top in cell A1. Data, go stocks. There we have it. So what is the WACC? The WACC is the weighted average cost of capital. And it is calculated by, you take your percentage of equity multiplied by your cost of equity plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate. So there's a few things that we need for this. The first one is the market cap. We know that easily. We go A1, open your brackets, market cap. Make sure to divide this by 1 million. Otherwise, it will make the cells go really large. Oh, sorry, doesn't have that. There we have it. The next line is the percentage of equity, which we can't calculate yet. Same with the cost of equity. The cost of equity consists of the risk-free rate plus your beta multiplied by your equity risk premium. These are components that we can't calculate yet, but I'll show you how to do them in a second. The next one is debt. After that, percentage of debt, cost of debt, tax rate, then we want total, and then we can get our whack. So let's go for the debt first. Let's try and be as methodical as possible. To find the debt, we come onto the balance sheet. So this is the balance sheet. We want to find, so current maturities of debt, this one, and long-term debt. So we add them together, 5569 plus 19602. There we have it. We want the sum of these now to find the total. Because we have the total, we can work out the percentage of equity. That needs to be a percentage. We do the same with the debt, because we have the total, we can take the debt divided by the total, gives us our percentage of debt. So as you can see, this is very much a predominantly equity. The tax rate, it actually showed it up here somewhere. There is a line saying tax rate. We are 17%, which is, yeah, pretty much what we calculated on the other one. We take, okay, so 17%. Cost of debt is, we're going to do this, 789 divided by the total debt. (3.135%) we'll say. Go. Okay, let's start going on to the cost of equity now. The cost of equity equals your risk-free rate plus your beta multiplied by your equity risk premium. So the risk-free rate's easy. We just go on to, we just take the US 10-year, and at the moment that's trading at 4.141. We just put that in here. 10. Nope, sorry, that goes in the risk-free rate. Your beta. So we have to pull up another spreadsheet. So we want to see what industry that Visa operates in. It's finance, but it's not a bank, so we don't use those. So we would say it's financial services, non-bank, and insurance. I would probably say, if there's a payment or fintech. No, there isn't. So we can actually just use this 0.27. when we find a company that operates in multiple industries, I'll show you how to build that beta then. But for now, let's just do that. The next one is the equity risk premium. So we need to work out revenues from we need to work out where Visa generates its revenues. It actually breaks it down to US and international. And this is actually all we need, and we can get a more accurate risk premium than if we just use the US one. Because as you can see, 15.5 billion of revenue comes from the US. The rest of that, nearly 25 billion, is international, which means that it's not going to be it's going to be nowhere near what the US risk-free rate. So we have to factor in all of those risks to those revenues. We go region, revenues, ERP, weighted ERP. So the first region, US. Second one, we're just going to go international. These revenues are 15,633. For international, 24,367. So the ERP, we come onto this spreadsheet. These are all available on Professor Damodaran's website. If you just type him into Google, you'll go to this page. You can find all of his spreadsheets. For this, you want to look for country risk premium or equity risk premium, and it will guide you to the correct one to download. So the US equity risk premium on this one is 4.61%. For international, let's just take out this line. It will give us a global risk premium, 6.41%. And this is a weighted average based on size of the country by GDP. So 6.41%. It's marginally off because that North America one includes Canada, which is slightly better than the US. So their average is lower than the 4.61% for the US. But for time's sake now, it's fine. This one, this is this is okay. So we want to work out the weight. We sum. We go to 40. You take your 15 divided by your 40. Lock the 40 billion in because we need lock your 40 in because we're going to use it again when we copy this down. There we go. So all we do is we take the ERP, we multiply it by the weight. Sorry, that needs percentage down. Just sum these together. 5.71 equity risk premium equals go. So your cost of equity equals your risk-free rate plus your beta multiplied by equity premium. Let's just put it back to 10. Go. So your WACC is, we do this formula here. Take our equity risk premium multiplied by the cost of equity Actually put these two in brackets. Plus, in brackets again, your percentage of debt multiplied by your cost of debt multiplied by 1 minus tax rate. Don't need we just go 5.56% the whack. Back onto the other spreadsheet. Go equals. Equal to that. Otherwise, it will stretch the column width again. So just format it like this one, and it will. So for the bare case, we take the base plus 0.5%. We do the same for the bull, but we minus 0.5%, because the lower the whack, the better it is for the price, the more bullish it is. We do the same for the terminal growth value, which we're putting at 2.5%. That might be a bit low, but you can put whatever figure you want in it, as long as it's lower than GDP. And by GDP, use US GDP. Yeah. Okay, the whack, you go equal choose. You take your whack. We have it. Get down. Okay. So yeah, so with this, you can still toggle these switches. I'll show you. See, comes adjusts. But yeah, we use the choose function instead of offset for those ones. Now let's come back here. Just add in another row and put 1 from the years forward that we forecasted. Just go 1, 2, 3, 4, 5. And you'll see why in a second. So to calculate the present value of unlevered free cash flow, we take the unlevered free cash flow and we divide it by 1 plus the whack to the power of the year that we're looking at. Let's remember to lock your whack in. There we go. Bold, just copy across. There we have it. So what this does is, this is the time value of money. $1 today is worth more than $1 tomorrow. So all of these cash flows that have been forecasted out, discounting them back to the present day, gives us these figures. So the next step is the terminal value. Here you take your final year multiplied by 1 plus the growth rate, the terminal growth value, divided by your whack minus your terminal growth value. Second, then we want the present value of the terminal value. Wow, 8 trillion. We'll adjust it in a second. We'll see. Divided by 1 plus the WACC to the power 5. Sorry, I have made a mistake. Come back up to your EBIT here. This is not the correct formula. You take your revenue and multiply it by your EBIT margin, which is your percentage of revenue. Copy that across. There we have it. That looks better now. Yeah, that's okay. That yeah, we can imagine this being a $2 trillion company at some point. What is it now? The market cap is about 600 billion. So in 5-6 years, that's not impossible. I wonder if we've been too optimistic on here though. 63. Well, no, I mean, look, it's done that in the past. Let's say it does it. This litigation get sorted out. I think we're okay there. The next step after the present value of terminal value is your enterprise value. That is, you go equals sum, you take the present value of the terminal value and all the present value of the cash flows we've forecasted. The next line is add cash, subtract debt. We know what the debt is because we've used it for the WACC. So we come over here, we take the debt, but for the cash, come back to the balance sheet. We have this one. It's 17164 plus 2990 equals 17164 plus 2990. There we go. Now we can get our equity value. Take add cash, subtract debt to your enterprise value. There we have it. The equity value. The next step, we want diluted shares outstanding, then implied share price. Before we do that, let's come back to this 64%, 65. The reason I'm not going to put this to come back up here is that at the moment, Visa is pretty much a duopoly with MasterCard. They own something like 90% of the market share, with, I guess, American Express owning the rest. What's potentially going to happen with stable coins, which can process transactions significantly faster? That if they start to get adopted, and then that will very much eat into Visa's margin. But because Visa has such strong network effects, and even if it might not be as good as compared to stable coins, this would still it will still take a while for it to lose its status. So let's say it comes to 63 rather than it comes back up to 65, 66. So okay, diluted shares outstanding. Come down to your income statement. We want diluted shares outstanding. We just add all of these up. Equals Sum 1966 5 129. Then the implied share price, you take your equity value, divide it by your diluted shares outstanding, and this gives us an implied share price of $825. So we come back up here. The upside downside is well, I mean, it obviously shows the significant upside. Let's look at the different scenarios. Go to Ultra Bear. 582, the best case scenario. Like 1300. So this would suggest there's some significant growth in Visa. We have to see what the litigation, the lawsuit, because I think the lawsuit that's happening is to do with the company's dominance along with MasterCard. So we'll have to see how that plays out then, and then reassess later on. But yeah, I mean that looks quite good. Obviously, this is not financial advice, but yeah, that's yeah, that's good. Let me know what you think in the comments, and we'll move on to the next one. I'm not sure which one to do next. Maybe something like Eli Lilly or Microsoft, Amazon. Those are big ones we still haven't done yet. So yeah, we'll look at doing some of those next. Thanks for listening, and I'll see you yeah on the next one. Thanks. Bye.